23andMe, we last covered in May of 2023, and we got a few comments. So I really just wanted to go through how we progressed and really see where the company stands and whether or not I'm taking a victory lap or I'm going to be raked over the coals. So if you don't know, 23andMe, symbol ME or me on the NASDAQ, currently trades at about 72 cents a share with a market cap of $348 million. They were founded in 2006. 23andMe is a consumer genetics and research company. The company has built the world's largest crowdsourced platform for genetic research. The company became public through a SPAC in 2021, and is like most SPACs at the time, it has fallen 92% since. And since we last covered it in May of 2023, it's fallen about 65%. So I'm going to say that's a victory lap for me, at least so far. But a quick look at the most recent financials, so fiscal Q3 2024, which is just the calendar year end of 2023. Revenues came in at $44.7 million, down 33% from the prior year. And for the trailing 9 months, down 25% at $155.6 million. This is partially due to their GSK contract being lowered amount from $50 million to now $20 million, and some of the contract terms changed, and I'll get into that in a few slides. But loss from operations was $281 million compared to a loss of operations of $97.1 million. This is primarily due to goodwill impairment of $199 million in the quarter. The impairment relates to a previous acquisition of Lemonade Health, a telehealth platform, which it acquired for $400 million in late 2021. And that's roughly, I think, about a third of the value of their goodwill. I didn't fully break it down, but their goodwill value on their balance sheet is only about $140 million at this time. So they've taken a significant write down on that acquisition. But moving down the income statement, unsurprisingly, net loss of $278 million. Like I said, primarily goodwill impairment, but it was a loss of 58% per share compared to a loss of $94 million in the prior year and a loss of 20 cents as well. But removing the impact of that goodwill, we had a slight improvement, but it was still a loss of $79 million. And in reality, goodwill, the reason why it's not the weirdest thing to remove is this should be recognized over time, more so than just a single quarter, because it's trying to reflect the fair value in their investments. So over time, you see the investment move, but since it's a private company, they effectively just put their inputs in and spit out a price, and they do that every year or so, which is why you're seeing it at the calendar year end. However, even if we look at the almost always more favorable adjusted EBITDA, which removes the impact of goodwill and removes the impact of stock compensation, the company had a negative adjusted EBITDA value of $47.7 million compared to a loss or deficit of $43.2 million the prior year. So by this metric, which normally actually inflates earnings a bit, makes the company look a bit better. Remember, they're the ones deciding these adjustments. It actually shows the decrease year over year as the company in this metric has declined, as the share comp was not as large over the prior year. And that's really why adjusted EBITDA, you need to look into what they're actually putting into it. And you can't just take the headline figure, because a lot of times they will report it. Sometimes they'll have the financial breakdown like I have here in the press releases, but a lot of them don't. But I digress, because I just don't like adjusted EBITDA. So a pro for the company, though, it still has a strong balance sheet, which I covered last time, which is why you haven't seen this. Getting ahead of myself. Over the last same period since last year, we've seen shares increase about 6% to 480.8 million from 453.4 million. Not the largest increase, especially given the weaker financial state. However, the company does have a significant out-of-money stock options, restricted share units, as well as potential future issuance for stock plans. If you are hoping for that lottery ticket style gains like you do in these turnarounds, these stock compensation metrics can really dampen your return. And now we're getting onto the balance sheet proper timing. A pro for the company is the balance sheet. So you're not seeing that cascading dilution because they have this strong backdrop in their balance sheet. So when you're seeing other companies with financial weakness quarter after quarter, year after year, the balance sheet is what can support it. And 23andMe does thankfully have it for shareholders. But that cash position is dropping over time. They currently have $242 million in cash with no financial debt, but netting out the leases results in a net cash position of 164 million, about 47% of the market cap. Obviously, you need to price it down into the market cap and the valuations once you get to that high amount. That being said, the company's cash flow is negative, with net cash used in operations, or cash used in operations, I should say, of 138.5 million over the past 9 months. If you just do a linear extension of the negative cash flow, you're looking at about under a year or so from the end of, about the end of 2024, before they dip into a net debt and lease position, and then about 1.3 years, so about April 2025, before they burn through all their cash at the current rate. Obviously, things can change. With this, they can issue shares, they can reduce expenses, which they're already doing. They're reducing their workforce, as well as they can issue debt. But many times, once you see that debt get issued, normally it'll be like convertible debt or something like that at a high interest rate. That's really the death knell for the company if you do see that. I'm not saying that's going to happen with 23andMe, but that is always a concern, is once you see that debt issuance, because it just spirals out of control. So why would someone want to buy 23andMe? I've seen many comments say it's a buy. A very recent comment, not picking on them, it just really emphasizes and highlights what bulls are looking at. It's a buy. They say, I'm not saying this, I should be clear. It's a buy at the current price. The upside greatly outweighs the risk. There won't be a competitor database half as deep as 23andMe for a decade with AI advancements and their massive database. Throw the financial results out the window, buy and hold. I disagree, but we'll go into the bull case. So the bull case for the stock really is they have this trove of genetic data, which pharmaceutical companies should be clamoring over. They should be really wanting to pay that premium since it's such a great database. But the reality just doesn't show that at this time. The company does have an unexclusive now, previously exclusive contract to license its data to GSK, a mega cap, Britain-based multinational pharma company, and they receive about $20 million, or they do receive $20 million per year as of their last contract up front, which is always nice. GSK in return gets genetic and phenotypic data, which 23andMe collects in the agreement. And they've had this agreement for now 6 years. Before, this agreement was exclusive, but now it's unexclusive. So that premium has dropped from $50 million a year as their last extension contract now to only $20 million. So if you do believe this data is just so valuable that every pharmaceutical company is going after it, why are we not seeing new licensing agreements outside of GSK? Now that it's unexclusive, they should be able to sell that point, but it's been since July, so about 8 months. And we've not seen an additional announcement. So where is this value from this genetic data, which is meant to be happening? Additionally, as well, the company does have some various phase 1 and 2A, which is just enrollment for 2A, treatments in development, which may provide some sort of value in the future, but that's still multiple years down the line. Phase 1 and phase 2 is not very progressed, or 2A, I should say specifically, where you need to either hit the market or sell it at a price where you have something substantial, which phase 1 is still very early on, doesn't have much value once you're only at that point. You need to get to that phase 3 at least before you're really seeing any sort of value developed in the market. And at this time, they probably don't have the funds even to take to market, so they'd be taking a haircut to sell it early on. But to wrap this up, I'll highlight a couple points. Referring to the previous comment, you can't just outright ignore financials regardless of if you're just a growth-oriented investment and looking at the future, 5-10 years in the future. You need to look at the risk reward of the company. Like the person says, they think it outweighs. But the real reason why you need to look at the financials in the case of 23andMe or any really other pharmaceutical development company is the risk is in the financials. That's what you're looking at here, is the risk. They have a declining cash balance as well as over the past year declining revenue, which puts a timeline on the company before it needs to raise capital in some form. Remember, you're an equity investor. You don't own the actual product, you own the shares in the company. So even if the product down the line does well, if your share is so diluted after multiple raises, which you will see in biopharma, it is meaningless if you bought in now, but it's been diluted a tenfold once the product actually has any sort of success, if it has that success in the first place. The other option you may be hoping for is some sort of a buyout, but the same issue occurs. It might be a year down the line or 2 years down the line from when you bought, and that cash flow burn has hit it so hard. Even since I last did the segment, not even a year ago, it has fallen over 60%. You think a company is going to pay a nearly 3x premium for a company if you bought it this time last year. And if it continues going at that rate, you're going to have to see more and more of a premium to get to your average cost before you see any profit. You're just trying to completely guess when a buyout is going to happen, which is just not a way to invest. So overall, the risk still outweighs the reward. And I really want to see if there's any potential in the company, I would want to see those additional licensing agreements, because that's where the value that people think is coming from. But for now, I just will not put 23andMe in my portfolio.
Excellent job.
Yeah, and the same.
Like, and isn't there
one thing I would wonder?
Go on.
I was going to say, one thing I would wonder is so when it comes to their database, do they have unlimited? I mean, if I were to use 23andMe's service, provide them with my genetic data, do they have unlimited use of it, or are there restrictions on that? Like, can I opt out? Can I say you can't use it?
I advise they burn that data right away and get rid of that genetic data.
There's actually a couple points I can go through here. Is
nobody wants it.
I believe in their terms and conditions currently, unless there's some regulations, because they do say people who have enrolled in the license to have their data licensed out. That is, so there's something in the terms of agreement. I didn't look too deep in that, but there is some sort of enrollment. Whether you can opt out, I don't know. That would be a concern. And as well, recently there was a hack, which was kind of their fault, kind of not. Is a bunch of passwords got exposed, not their fault, but this happens all the time with databases. But the issue with 23andMe is, since you're all connected, you can use puzzle piece A and C to figure out B.
Yeah. And
that's what happened here. They effectively use the strength of the connection to the platform to expose people's passwords who weren't exposed, or accounts weren't exposed, to the data risk. And that is something which obviously is a concern. There's lawsuits about it as well. And that is obviously a concern and as well, you could see that regulations change as well with something like that.
Yeah, certainly. I mean, especially out in Europe as well, right? But, in North America as well, there's a big focus on data privacy. And, it might not be a case where, it may have been a case where when they started collecting this data, that they had greater latitude in terms of what they could do with it. But since then, there's been regulations that have, restricted. I don't know specifically with respect to them, but I know that particularly in Europe, there's a big focus on data privacy, and there's been a growing focus on it in North America as well. So just something to consider. Yeah, but at the end of the day, I mean, they have had 8 months to sign new agreements to generate cash flow from that database. It still hasn't happened, so that would be a concern. Once they run out of money, they're going to have to start taking more drastic actions to stay afloat, right?
Yeah. I don't know if you guys saw, like, this is or go on, Ryan. You can say first, because mine's a bit of a tangent.
No, you go
on it. It's kind of an interesting. Okay, so a few years back, I think it was back in 2018 or 2020, there was a site. They don't list exactly if it was Ancestry.ca or 23andMe. They say that it was a different site, but they ended up using the database and basically linking, like they put in this DNA from this one murderer. Again, back in, he was murdering back in like the 1980s. They ended up linking him, or this DNA, to one of his siblings, and ended up catching him like that way by figuring out that it was, a link to a sibling. Anyways, it's kind of a tangent, but just interesting how, who knows what website this was that, is, allowing their data to be, used like this. And I mean, it's good that we're getting a murderer off the street. Don't get me wrong. But it's just, it's an interesting use of data that, they're also tracking down criminals that way as well.
What I was going to say is as an equity investor, like as far as the value of the database, the data they're collecting, I mean, the same argument could have been made when they're $10, $9, $8, $7, $6, $5, $4, $3, $2, and now they're below $1. You could have had that same argument then. You're left holding the bag as an equity investor if that's your only reason for owning the stock. Perhaps that database gets bought. It has a value at some point, but we have seen these where literally the equity has got to zero and the database is bought out of receivership. So, I mean, that can happen in these cases. And I'm not saying that's going to happen here today. I mean, there is significant sales still, but trying to pick your entry point based on the value of a database, we'd rather have a valuable database and cash flow, and then maybe it would be something that would be attractive to us. And the database or the buyout would be a bonus. You got to value the company based on that cash flow. Otherwise, it's just pure speculation, and it's not something that we would consider investment worthy.